Hi, this is Mark Wahlstrom, and welcome to Speaking of Settlements, a featured broadcast here on the Legal Broadcast Network. Well, you're joining me once again today in the middle of a market plunge. It seems like every time I'm back on Speaking of Settlements, there's some crisis. AIG is being taken over, the market is collapsing, the free world is ending, biblical events are unfolding in front of us. I only joke a little bit, but obviously troubled times. And we are treated this morning to wake up to a headline from the New York Times saying life insurance companies face credit rating cuts, as if this is now huge news and dire news that people need to be afraid of and paranoid about. And this followed yesterday's headline that Genworth, the new name for what was a very old and powerful company, GE Capital, it was cut from a double A to a single A yesterday by Moody's. Now, the reason I want to talk about these is because I've reached the point, now that we are 6 weeks post the AIG takeover. We're in the midst of this meltdown. We've seen the $750 billion bailout bill. We see General Electric and General Motors, Chrysler, Ford parading up to Capitol Hill asking for their money. That this has now turned into the ultimate pigs feeding at the trough. If you notice, there aren't a lot of companies collapsing right now. If you notice, there are very few banks being taken over. There are very few brokers who are having difficulty. There are no life insurance companies that I'm aware of or that the press has reported or even through my sources that are having difficulty meeting their obligations. What's happened is that the government, through this bailout program, has now created a fund called TARP, the Troubled Asset Relief Program, that banks, nationally chartered banks, and certain insurance companies and brokers can line up to go get money. Well, let me tell you what's happening and what's at play here. Are life insurance companies in trouble? No, I don't believe they are. Even AIG, with all the headlines and all the problems, now with the government putting $150 billion into that company, now with the government owning essentially 80% of it, even though the terms have been reworked, what is occurring is a more orderly, a slower sale and reconfiguration of the company than people expected. But the life markets, in the life insurance markets, which is what I'm here specifically to address, are under no stress and no duress. What's happening is this. The credit agencies who have been burned before in the executive life and Confederation life insolvencies of the late 80s and early 90s, they had AAA ratings on companies right up until the very end in the time that they collapsed. The reason is most credit ratings are based on historic results. They don't look at current market conditions, and they are very concerned about their liability from investors and people who buy insurance products or buy annuity products from an insurance company based on the credit rating. They don't want to be sued because, we said it was a AAA rated company like Executive Life or Confed or Mutual Benefit, and they went belly up. Now, never mind that people didn't lose their money in those insolvencies and that the annuity holders came out whole. The fact is that we're seeing an overreaction from the credit rating agencies at this time because they don't know what these insurance companies are holding. They don't know how much bad paper they have. They don't know how much bad debt they have. And now they're overreacting to the fact that the insurance companies, rather than reporting huge, robust earnings, are actually adding to their reserves in order to properly reserve and protect policyholders on various lines of annuity and life insurance contracts. What I want people to be very clear on, and I think that whether this is a consumer watching this, whether you're a financial professional, stop and think about what we have here. We have life insurance companies who are voluntarily, in many cases, or under pressure because they want to maintain top flight AAA or AA plus credit ratings, are willingly adding to reserves, or they're raising capital in the markets through sale of stock or sale of preferred stock or partnering with other investors to raise the reserves and to raise and improve their capital position. We are not talking about insolvencies here. What people have got to understand, and what the financial press and the general press doesn't do, and does a historically very poor job at doing, is that we have a situation where people are confusing stock prices and earnings with solvency and stability in these life markets. You can't confuse the two issues. Just because a company reports bad earnings that quarter, most of those bad earnings are a result of them having to plow a lot of additional money into reserves in order to protect policyholders and insureds. That's a good thing. That's a positive thing. That's something that people can sleep well at night knowing that their insurance company not only willingly does it in many cases through decisions of their investment policy and board of directors, but is compelled to do it by state regulation and National Association of Insurance Commissioners guidelines. People have got to get off this panic of, well, gee, they went from a double A to a single A. A double A rating to a single A rating is going from excellent to very good claims rating ability. That's not an issue of insolvency. Most companies that are rated A by AM Best and double A or single A by Moody's and Standard & Poor's are excellent, outstanding companies. Now, yes, it raises the perception that, well, maybe there's problems at this company. You cannot confuse, and I'm going to say it again, don't confuse stock prices and credit ratings with solvency issues. If you actually take the time to read the New York Times article, and it's on my website, it's on both our websites, it's at Speaking of Settlements and it's at thesettlementchannel.com. If you go and you look at it and you read, two-thirds of the way down the story, they say, of course, MetLife may participate in the TARP program because MetLife wants to borrow the money in order to go buy other life insurers. Does that sound like a company that's having problems? No, it's not a company that's having problems. It's a company that's making strategic acquisitions. The other thing that people need to be aware of and that they've got to get their hands around in this entire insolvency issue and this panic is that when an insurance company is putting money away for its annuity holders and policyholder reserves and investing in a line of business, one of the things the article says is that they're selling and have sold so many financial guarantee products in the annuity area that are working as exactly designed. They're protecting the policyholder's value in their annuity. They're making sure that their guarantees are be paid. And, oh, by the way, they're saying that the baby boom generation is desperately going to need these products and services. Again, these are companies that have created products and services that are working as designed, delivering as promised. That is a great thing. That is something that as we come out of this hysteria that we're currently in, much of which I think has been brought on by the financial press and by the bumbling of the Treasury Department and the Bush administration and Congress in the way that they've handled this. Anytime the government gets involved, there's going to be mistakes, there's going to be disasters, and that's partly what we're looking at. But I wouldn't shy away from any of the life insurance companies that are being bandied about as, maybe they're in trouble, maybe they're having issues. Don't confuse a liquidity issue over the short term with the stability of the company and the viability and the attractiveness of their product. I've mentioned it before, and I'll close on this comment once again. Those of us who are in the structured settlement business, those of us who sell financial guarantees, we sell annuities, sometimes variable annuities, sometimes fixed annuities, sometimes structured annuities. But annuities are a promise to pay. They are a transference of risk. When you buy an annuity, you are getting a promise from that insurance company that no matter how long you live, your payments are going to be made and guaranteed. It doesn't matter what happens to the stock market, the real estate market, the bond market, your check keeps coming. If you buy some of these other financial products that the insurance companies are selling, other variable annuities where you have the ability to participate in the market, plus if the market goes down, you maintain your cash value in that contract, those are good things. Those are things that people are going to want. Those are things people are going to need. And as they come out of this traumatic period of seeing their stock portfolios drop by 50%, seeing their real estate drop by 40, 50% and be foreclosed upon, people are going to want guarantees, and they should want guarantees. And the life insurance industry is going to come out of this even stronger, more attractive, and those of us who sell annuities and structured settlements and guarantees for the people who need them, widows, orphans, the disabled, and the retired, people who've got to have a check every single month. We are going to be the people who have delivered on our promises, and that's going to be a great thing for our industry, and it's going to be a great thing for the people who are in our business. So don't let these headlines scare you. Know the facts. Be prepared to explain those facts to your clients. Invest in your business. Let your client, don't go into a foxhole. Be out there talking to them. Let them know what's going on, and you're going to be amazed at the golden age that we are about to enter. Again, this is Mark Wahlstrom. Thanks for joining me this week on Speaking of Settlements. I'll be back again here next week on the Legal Broadcast Network.